So glad you are with us on the Retirement Compass. Brad Johansen with Tim Kulhanek and Jeremy Gove, Stonebridge Wealth Systems. It is always a pleasure to be back with you guys on set. How are we?
Yeah, we're great.
We're good.
Well. Yeah, doing well. Thanks, Brad.
We're good until we talk about this thing that we continue to. This thing is taxes that never seems to go away. Well, you may be hit with it in the initial and say, okay, I'm past this, but you've probably been told some things that we probably need to clear up, especially if your retirement's going to last a long time. And isn't that what you want? We're going to move into this and try and clear up some misconceptions and maybe have a greater understanding of where you are, because this may be the greatest hurdle that you face in your retirement. Tim, I want to start with what we hear all the time.
Yeah.
Don't worry about taxes because your taxes are going to be lower in retirement, so it's not going to be a big deal.
Yeah.
Why is that such an elephant in the room for us?
I hear it all the time, and I like to kind of separate out the difference between tax preparation and tax planning, because they're two totally different things.
Totally
right?
different, yep.
But oftentimes there's some confusion, and those try to get the water gets a little bit muddy, and people think, oh, well, you know, my accountant said that I should put money in a traditional IRA this year because that's going to knock me out of that 22 back into the 12% tax bracket, and I don't want to be pushed into a higher tax bracket. And a lot of times I look at that, I'm like, well, 22 actually sounds, have you looked at the history of tax rates? You know, I did a workshop recently, Brad, and after we got done, there's a gentleman who was like, a lot of people come up and want to ask questions because they want their specific questions, you know, to be answered. And I love doing it. Like, my mother's a teacher, you know, I've got the heart of a teacher, and so like it's where I'm in my kind of comfort zone.
Good.
I saw him kind of milling about and like popping in and out, like he needed to go, but he still wanted to answer to his question. He took off because I had a long line. I'm going to my car and he catches me in the parking lot. And I say, hey, you know what? I'm sorry that I had such a long, you had a question. I know you had a question. How can I help? And he said, actually, Tim, I just want to tell you, I retired. I worked for the IRS for 35 years. And my initial thought was like, oh no, like
what did I say?
There was an auditor here.
That's right.
You know? And he said, I just wanted to tell you, when I started at the IRS, the top income tax bracket was over 90%. 90%. Yeah, today it's 37%. So there's this theme that people have that like, oh, tax rates are so high right now. Tax rates are some of the lowest rates we've seen in history. Yeah. And the reality is, as you move through retirement, you get less than, you actually lose more and more control, because the government gets to a point where they say, hey, you know what? You've been hanging out and feel real comfortable with this money, just defer. But now we want our share.
Yeah.
Because when you have retirement accounts, and there's probably like $42 trillion in the United States in retirement accounts, I would guess the majority of that isn't tax deferred, right? Because, you know, back in the 1970s when ERISA passes, which is the Employee Retirement Income Security Act, it's kind of the birthplace of retirement accounts. Eventually you had 1978 Revenue Act, created the 401k, and you had that shift. There was no Roth. That wasn't until a lot later, right?
Yes.
And so you got all this tax deferred money, and a lot of people, you may not know this, but eventually the government says, hey, that was kind of like a partnership with us, and we want our cut. That's why it's a misconception, because eventually you lose that control. You're forced out, and it could be at a time where all of a sudden you got Social Security, maybe a pension if you're lucky, and these required minimum distributions could put you on a much higher tax bracket.
And the rules on RMDs change. We could probably get into that as well. But the idea moving forward, Jeremy, I want to talk about penalties, and I think the biggest one that we hear is, well, widow's penalty. What's a widow's penalty as we start going forward in taxes?
That's a great question. And a lot of people will think every tax is a penalty, and I probably agree with that. Yeah. But let's talk about the widow's penalty specifically. We have a slide that we can pull up. And in our example, we've got a married couple, and this actually can be pretty devastating for the surviving spouse, because their income, if you look on the left side of this slide, you have an income of $100,000. Some of that's coming from his Social Security, her Social Security, a pension, RMDs. And with a $100,000 income, they're in the 12% tax bracket. Okay. Now, as a single filer, after one of the spouses passes away, or one of them passes away, The income drops just simply because they lose the lowest Social Security. And you can see that on the slide. We lost that $25,000. So now our income's at $75,000. And we still get his Social Security benefit, the pension, the RMDs, but the tax bracket changes.
Yeah.
So it pushes us into the 22% tax bracket. So not only do we have less income, but now we're paying a higher tax.
Gone from best to worst.
Best to worst. And now, so our disposable income after we pay our taxes is significantly lower. So we don't have as much money to take care of our, property taxes, our living expenses, and all of those things.
Okay, but I mentioned RMDs, so I'm going to get to it right now because we have these age things. Well, we think we have the age things because the government decides to change the rules on all of this. Because RMDs were at 70 and a half. We were set there.
Yeah.
Then they went to 72. And now we are at 73, which is a magic number, but only for a period of time because they're going to change it again to 75. Why is 73 so significant now?
Yeah. I think there's a couple different ages. When I'm talking about tax planning, there's a couple different ages that I think our audience really needs to understand the importance of, and that is 63 and 73. 63 is really critical because once you get into retirement, all the rules of the tax game change, right? So, for example, it's not about just taxes. We can see our income tax, but it's the interaction, the play between different types of incomes that can basically move non-taxable income into ordinary income. I'll give you an example. Let's say that you're 65 years old and you're on Medicare and you draw Social Security. Well, Social Security, if that's all your income was, you wouldn't pay any tax, actually. Social Security originally wasn't taxed at all. It wasn't until like the 1980s and then again in the 90s where they put these two brackets in place, never adjusted them for inflation. We can get to that on another show. But it's called provisional income. But like from like an intuitive perspective, sometimes you say, okay, well, I'm just taking Social Security and I pay no taxes, and so maybe I could take $10,000 out of my retirement account and still pay no taxes because it looks like I've got that much runway. But that $10,000 withdrawal could actually cause income on the worst case scenario, $18,500 of income.
Yeah.
Why? Because it could push 8,500 Social Security dollars from non-taxable, like line 4 or 5A or whatever it is, to 4 or 5B, which is the taxable column, right? So why 63 and 73? Take it a step further. Medicare premiums are essentially means tested, okay? The more income you have, the more they make you pay for your Medicare. Well, there's a 2-year look back on that. So the year I reach age 63, the income I have that year is what's going to dictate how much I pay if I go on Medicare at age 65, right? Because of the 2-year look back. 73, if I was born between 1951 and 1959, my required minimum distributions, we call it required beginning date. I have to take my first RMD by April 1st of the year following the year I reach age 73. Who makes these rules? Let's make it more confusing.
I know.
So it is confusing, and that's why I think having a guide that has been through this before, like an experienced advisor, holistic planning, like the advisors at Stonebridge, is so critical because it's a maze. There's lots of tentacles.
Next generation. Do retirement accounts create tax problems for the next generation? Look, we're just trying to get through the tax problems we got now.
Right.
But we're dealing with things and saying, you know what, I don't need to worry about this because I can do this. But what are we up to now, Jeremy? Maybe $90 trillion that are probably going to be passed from this generation down to the next, and most of it with taxes attached?
Yeah, it's a significant number. And I don't know the exact number that's in 401ks and deferred tax accounts, but it's a big number. And the Secure Act actually dramatically changed that. So the Secure Act, when you inherit an IRA, historically you would be able to stretch that over your lifetime. So if let's say I'm 60, one of my parents passed away and I inherited a $1 million IRA or 401k or whatever it was. I could stretch that income out over my lifetime. What's changed dramatically is now I have to deplete that account in 10 years or less. And obviously I'd probably want to try to stretch that out over 10 years because $1 million, I'd have to take at least $100,000 a year out. If I'm already working, and this is the challenge that most children face, they're probably in their prime earning years at that point in their life, because if you're in your 50s or 60s, you're probably thinking about retirement yourself, and you have this, so your income is really good. Hopefully, it's at the peak of your lifetime, right? And so children, grandchildren, that's where it becomes a problem. And the high tax brackets, we talked about that. If I'm in my 60s, and to Tim's point with IRMAA, there's just a lot of things that can come into play and become a problem if I'm having to deplete $100,000 out of an IRA on top of my ordinary income. That I can easily get pushed into higher tax brackets really quickly.
Complicated? You bet it is. And the rules, continue to change. But as Tim said, we're in probably one of the best marginal tax rates that we've seen in this country's history, which means you have an advantage to try and take care of the rules the way they are now before they're going to change them again, which is why you need to put together a written financial plan. Well, what's that going to cost me? It's complimentary at Stonebridge. 866-256-7778. You can scan the QR code on your screen. Let's get together and talk about all of these complicated rules and simplify them so you can take advantage of them while you have the rules the way they are now. 866-256-7778. I've got a tool coming up for you, so maybe you can understand where you are. Stay tuned. We'll be right back.
My story started when I was in college. I was trying to figure out what I wanted to do. I knew it was going to be in the financial industry. I took a lot of accounting and finance classes. I thought I'd probably work in like a bigger company and work my way through maybe the accounting department. But then when I was doing a internship the summer before my senior year, I walked into a business. I was trying to sell magazine ads. I don't know if I call it magazine ads, but basically ad space in the back of the UNK Student Handbook and Planner, which was a difficult sell because, nobody uses pen and paper planners anymore, at least not college students. But I made my best pitch to some financial advisors. I happened to be Scott Noctegal that I met with that day. When I went for the close and tried to see if he was ready to sign up for some ad space, he said, no, I'm not interested in that, but it takes a lot of courage to have somebody to be willing to walk into a business, especially a business that really doesn't cater to your target audience, to put yourself out there in a way that the odds of you being successful are probably pretty low. That's the type of person we'd be looking for at our firm. Have you decided what you want to do? And I said, no, I really haven't, but I only want to work with finance because I like numbers, and math's always been my favorite subject, and working with kind of complex equations, almost like a puzzle. And so that's really where it all began.
So glad you're with us on the Retirement Compass. Brad Johansen, Tim Kulhanek, and Jeremy Gove. Stonebridge Wealth Systems, and what they're here for constantly, it's why you've been watching, is education. Can you explain this to me? Here's something that we want to have up as we continue on this tax road that is not fun to traverse. StonebridgeTaxBill.com. You can scan the QR code here. And I want you to be able to go to this while we're having this discussion. Very quick, user-friendly, gives you an idea of all the money that you've put away tax deferred for a while. That's what we've been told to do. And how it may creep up on you, and what Uncle Sam wants now, later, and to the next generation, and the strategies that may be available to you to use right now. So I want to get into that, Jeremy, because you kind of talk about, how do you put it, the golden window before the age of 73, when most advisors are now saying, you don't have to worry about taxes until 73. You got plenty of time now. Why are you saying golden window now?
Well, if you wait till 73, it's a lot more challenging to make changes, right? So we talk about, at Stonebridge, we talk about, that golden window starts from when you retire up until 73 or potentially 75, depending on when you were born and when you have to start taking RMDs. But let's just assume, let's just use an example of I'm retiring at 62. So that means I've got 11 years to potentially utilize the tax code the way that it's set up today. We talked about taxes are actually relatively low compared to historical taxes, right?
Right.
And so maybe I can live off my savings. Maybe I'm working part-time. Or maybe I lost a job due to reorganization and I have a severance package that I can use. But however that looks, whatever that plan would look like, if I can draw income from other places and not have to take money out of my retirement accounts, that allows me to be able to do Roth conversions. Maybe I can convert part of my IRA each year over to a Roth IRA because I have a window of, well, I don't have to take any RMDs out, but I have this window of, let's say my income is $60,000 a year and I'm in the 12% tax bracket. If I'm married, that leaves about a $40,000, I guess I'll call it space between going from our 12% bracket into a 22% bracket.
A little wiggle room.
A little wiggle room. And so that gives us some planning flexibility. You don't have to do all 40,000, but it's just, let's put a plan in place that makes sense for your specific situation.
And it does seem to make sense. Is it for everyone? I guess we ask this, when do we know whether Roth conversions are right for us, Tim?
I love the question because the reality is and Jeremy qualified it on purpose, everybody's situation is slightly different. And so, when people watch this show, I want to make sure that when they hear us saying these things, they're not like, oh, well, then I guess maybe I should do one. Maybe I should go talk to my advisor about it. Well, that's fine if you do, but in the world of like financial planning, so if you think about it this way, just maybe a comparison or analogy that people relate to is, everybody has a GP, right? A family practice doctor they go see. If they got the sniffles,
Sure.
Hey, kid's got something going on. We've had that at our house, You go and see, the family doctor and they look you over, listen to you, maybe, shine the light in the back of your throat and say, oh, yep, take this and you're going to be better here in a few days. And if not, come back and see me. But, if you think about it, if I had something really serious going on, like I'm like, oh, the ticker ain't ticking like I think they say it should, and I need to get something done. Maybe I got a blockage. I'm not going to go to the GP and be like, hey, will you shine that little light and put the thing on my finger and have me stand on the scale? I need a specialist. I need someone who specializes in the heart, right? That can go in and get things done. I'm not going to say, hey, doc, can you get me in later today for like sticking a stent in there and making this thing work better? In the world of financial planning, the way that we operate at Stonebridge Wealth Systems is as that specialist category, okay? We're not focused on just like, high level, accumulation phase type stuff. It's distribution phase. It's looking at like, not just how much you earn, how much you keep. And so how do people know? Working with a specialist would be step number one. But for those who are maybe listening to this, are like, oh, well, I'm not sure I'm ready to take that step. That's why that Stonebridge tax bill exists. That's why we built it. That's why it's on the screen. You can go there and get that information.
So this calculator, what reaction have you got from people taking this calculations? You need to be sitting down sometimes for a lot of people when they're doing this.
Yeah, in a word, shock. Because a lot of times, let's say somebody's got $1.5 million in their retirement accounts. So you've got basically two different ways to go. You've got the government's plan and the alternative plan. I call it mandatory tax bill and the optional tax bill because I can't make you pay no taxes. I had somebody in the office the other day and he said, hey, Tim, I was talking to somebody and they said once you're 59 and a half, you don't have to pay taxes on your IRA anymore. Man, wouldn't that be nice?
I sign up.
I'll sign up. I said, that's just when they don't penalize you. But, if let's take Stonebridge Wealth Systems. Let's say Jeremy owns 50% and I own 50%, hypothetically.
Okay.
I don't know if Jeff and Scott are going to like that, but hypothetically, like whether Stonebridge is a small company or a big company, if the company is sold, he still gets half the money. Well, in your retirement accounts, the government is your silent partner. They still get their percentage. The only difference is if Jeremy and I want to change the ownership structure, we both have to agree to it. Does the government have to agree with you if they want to change how much? No. No.
Okay. You need scan the QR code here now, but I want to get to something else before we go to break. Jeremy, we got a lot of retirees, state of Nebraska, who are dealing with this. Cash balance plan. Why do we need to touch on this as we're talking about taxes here?
Well, so I think the natural instinct for a state employee is to allow their money to stay in the Nebraska cash balance plan because it earns 5% every year. The challenge with leaving that money in there is you have no flexibility. There's no planning that you can do as it relates to taxes. that money is still growing tax deferred. So if you wait till 73 to start pulling that money out, not only did you gain 5% every year, because that's what we know, it's the minimum that would be credited, you're also going to increase your tax bill when you turn 73 because that account balance is continuing to grow. So the natural tendency is they're tempted to just leave that money in there. If you roll that out and have other options to put that into an IRA, now you're taking control. And that tax bill that we're talking about where that could continue to grow, if I can start converting some of that money over from tax deferred to tax free and utilize the tax brackets that I'm in, that I have available to me, there's a lot of planning that can be done there. And it doesn't make sense for every person, but for the majority, I would say 90% of the time it's going to make sense.
You said it perfectly. Utilizing what is available to you. Scan the QR code. This gives you an idea of where you are. And then probably you need some help to utilize what you have at your advantage right now. 866-256-7778 for your complimentary written financial plan. Wouldn't you like taxes to be lower in retirement? Wouldn't you like to get Uncle Sam out of your pocket? Let's work on a plan that is yours and yours alone. 866-256-7778. Scan the code now, and we'll be right back to wrap this up in a moment.
Have you ever taken your family out to dinner and been shocked at how expensive the tax bill was? Well, guess what? Right now in the United States, there are around $37 trillion in tax-qualified retirement accounts like pensions, 401ks, and IRAs, and the vast majority of those dollars have never been taxed. Hi, I'm Jeremy Gove, partner and financial advisor at Stonebridge Wealth Systems, and I want to take a moment today to have you think about how much money you have saved in tax-deferred retirement accounts. Did you know that not all of that money is yours? That's right. When you put money into an IRA or 401k, that is like going into partnership with the IRS. At Stonebridge Wealth Systems, we have created a free online tax calculator to show you what you could pay in future taxes on your retirement accounts. Go to stonebridgetaxbill.com or scan the QR code below. That's stonebridgetaxbill.com.
So much to talk about on the Retirement Compass. Brad Johansen with Tim and Jeremy, Stonebridge Wealth Systems. We're going through it. I'm going to hit as much as we possibly can before we get into this. And we've got a few changes.
Yep. Yeah.
You want to make sure you highlight at least a few of the
Sure.
tax law changes.
Yep.
Give me some.
Yeah, I'm going to pull them up on the screen for you folks as well to walk through together with us here. Because 2026, significant changes that took place here. And we're going to go through a few, right? We're not going to spend a lot of time on them. That's why you can give us a call and we can walk through these so we can know exactly how it impacts you personally. Biggest one is on the top left. That's $6,000 extra deduction. Doesn't matter if you're itemizing. Doesn't matter if you take the standard. If you're 65 or older, you get an extra $6,000 just for being 65 and older. Okay. Now there's phase outs. There's a lot of gives and take backs with this. We'll talk about that on a one-on-one. Catch-ups must be to Roth. We'll talk about that in a second. But the reality is the government needs money now, so they're going to force you to take, instead of the deduction, so to speak, with a pre-tax contribution, it's got to go to Roth. Next couple we have right here are going to be SALT deduction. This is big for people in states with high income tax or property tax. Nebraska, for example, really high property taxes. So it used to be, SALT stands for state and local income tax, okay? So it used to be that was capped at 10%. They now raised that to $40,000, but guess what? There's phase outs. So if your income gets above a certain threshold, it's going to be a like 1 to 130 type of ratio where for every dollar over the threshold you go, they're going to pull back $1.30 until you're completely phased out. QBI deduction is going to be for our business owner clients. They've made that permanent. They've adjusted the rates. That's a really, really good thing for our business owners out there, small companies like LLCs that file as S-Corps and things like that. And then finally, two more that we have on here for you are going to be above the line charitable deductions. That starts in 2026. So if you give money to charity, keep a hold of those receipts, right? We call them contemporary written acknowledgments because you can actually do above the line. That's important because that's above AGI, which means it doesn't count towards things like your modified adjusted gross income, which impacts a lot of different things, including IRMAAs, income-related monthly adjustment amounts for your Medicare. And then the standard deduction, it went up for everyone.
Okay, and it's a lot, which is why you need an expert. Here's some of the confusion, Jeremy, on $6,000. Hey, I just got a $6,000 break. Give me a real-world example for what $6,000 is.
Yeah, so a real-world example is we have a couple that's over 65. Both people are over 65. So we get that additional $6,000 per person. So that'd be a $12,000 deduction total. That does get phased out, as Tim mentioned. It starts if you had an income at $140,000 a year, you would still draw that full $12,000. That starts to get phased out at $150,000. So after that, that's where that's gonna start to phase out. But in this example, if I'm taking a $12,000 deduction and I'm in the 22% tax bracket, that's gonna save me $2,640 in taxes. And that's significant. A lot of people will say, well, that's $12,000 or $6,000. What does that actually mean to me? That's a pretty big amount of tax savings if you think about that.
Yeah, it's a
absolutely.
big aha. We don't have a whole lot of time, but I want to get to catch up. Tim, can we get to catch up on what that means and why that's significant for people?
Yeah. So captured contributions just means once you reach a certain age 50, you can put more money into retirement accounts. Okay. So for like an IRA, last year it was $1,000. This year it's inflation adjusted, so it's $1,100. I've got a slide I'll show for just a minute, and then we can get this on one-on-one. But if you're 50 to 59 or 64 plus, regular catch-up this year is $8,000. So your 401k, you can put $24,500 in that thing, regardless of your age. You can add $8,000. If your income last year was above $150,000 in 2025, all catch-up contributions must go to Roth, okay? So, and this is for 401k specifically. So you don't have a choice. What is this signaling to you, folks? If the government is saying we're gonna force this Rothification on you, we want more money going to Roth, it tells you one thing, and it's that they want the money now.
Yeah.
So clearly tax planning should be a part of your plan. If it's not right now, you need to make it that way. I'll tell you this, to leave you with this. If you're going on a plane, you're going on a trip, and there's two jets, and one has a seasoned pilot who's been flying his whole life, and the other one has no pilot, but there's a little computer in the cockpit that tells you how to fly it. Which one are you gonna choose?
Choose the one that have been doing it for decades. The Retirement Compass leads you on the right direction. Make the call now, 866-256-7778, because this is tough to do by yourself. Let the experts do it. You need a specialist. We're grateful for your time here. See you in the office. We'll work the whole thing out just for you. Be right back here next time.